If you've been living under the rock, blissfully and ignoring the news and thinking it's just the same old, brace yourself.
Australians were expecting more interest rate pain today.
As it defied market forecasts and the predictions of most experts.
Inflation has peaked. It expects a further pickup in wage growth.
It's not just your morning coffee getting pricier. There are some rate changes sneaking up on you that might just shake your financial tree. Let's dive in. First off, for all my fellow students and graduates out there, remember that HECS loan we thought was so harmless? Well, it just got a bit more hefty. For those who might not know, HECS-HELP students' loans are essentially interest free, but they are tied to inflation, meaning loans increase each year in line with the Consumer Price Index in a process called indexation. Think of the Consumer Price Index, or CPI, as a measure of the average price of a basket of goods and services over time. It's like checking how much your weekly grocery costs now compared to, say, a year ago. If bread, milk, and other essentials cost more now, the CPI has gone up, indicating inflation. And then we have indexation. In the context of HECS-HELP, indexation is the method used to adjust your loan to account for the effects of inflation. So if the CPI goes up by 2%, your loan will also increase by 2%. It ensures that the real value of your loan remains consistent over time, even as the purchasing power of money changes. So while you're not paying a traditional interest on your HECS-HELP loan, thanks to inflation and indexation, the amount you owe can still grow, which is exactly what happened at the beginning of this financial year. The HECS-HELP debt for over 3 million Aussies increased by 7.1%. That was almost double from the previous year's 3.9%. If you had a student debt of 24,000, that meant an increase of 1,700. Alright, moving on to Division 7A. Now, for those scratching their heads, Division 7A is essentially a set of provisions that prevent private companies from making tax-free distributions to shareholders or their associates. Think of it as the ATO ensuring everyone plays fair. In a nutshell, Division 7A ensures that any money or benefits taken out of a private company which aren't declared as wages or dividends are treated as loans. These loans need to be repaid to the company, or if not, they are considered as taxable dividends, which means you'll have to pay tax on it. This topic is quite complex, so we have a video specifically dedicated to answering your questions. But if you're up to date with the ins and outs of these loans, you need to know that the minimum repayment interest rate for Division 7A has also seen an increase. Why? Well, this minimum interest rate is based on RBA benchmark lending rates. So the higher the benchmark interest rate, the greater the annual minimum yearly repayment will be. Now, because the RBA has continuously increased the cash rate target since May 2022, the Division 7A benchmark rate has also increased. So the current rate is 8.27% for repayments for 2023 to 2024 income year. What does this mean for you? If you or your business have a Division 7A loan, the amount you need to repay annually has gone up. So you should factor this into your financial planning to ensure you're not caught off guard. If you're unsure about how this impacts your specific situation, it's always a good idea to consult with a financial advisor or accountant. And just when you thought we were wrapping up, let's talk super. Each year, the mandatory contribution you make to your employees' super fund is on the rise. For the 2023 to 2024 financial year, you will need to contribute 11% for your employees' earnings to their super. And by July 2025, this rate will climb to 12%. While this means your employees are getting a more substantial nest egg for their retirement, it's crucial for you as an employer to ensure you're contributing the correct amount. Failing to do so can land you in a hot water with the super guarantee charge. The superannuation guarantee charge, or SGC, is a penalty that employers face if they don't provide the minimum required super contribution for their eligible employees. It's not just a shortfall in the super payment. The SGC includes an interest on that amount and an administration fee. In short, it's an expense you'd rather avoid. So, make sure you're on top of these changes. Regularly review your contribution percentages and keep your business compliant. Now, I know this is a lot to take in. Percentages, rates, terms that sound like they're from another planet. So let's quickly just wrap it all up in summary. HECS indexation rate has increased. Division 7A benchmark rate has increased. The super guarantee percentage has increased. Make sure you're staying informed, adjusting your financial strategies accordingly, and always seeking guidance when needed. See you next time!